And we're back. The American voters versus the banking system. And we're at chapter 6 now, after getting the book mended back together, because it was a little scrupled up. And this is by Thomas Shaw, retired CPA, expert witness, providing this great knowledge to us that we are so blessed to have. Where did we go? Let's get back here. Get back to the basics. There we are. Chapter number 6. Expert witness. A good court expert witness will use strategies to outthink his opponent. In one of the court cases the government sealed, I accurately predicted nearly every response the banker's accountant would say on the witness stand. Our side rehearsed every question and every possible response the banker could use. In a matter of 15 minutes, it was like the sinking of the Titanic. Reports I received from eyewitnesses claim the sheriff fleeced everyone of any notes, materials, and told everyone they could not discuss the case. 3 days later, the judge's picture was missing on the wall of the court building, replaced by another picture. The court claimed the judge never existed and that the case never took place. More than likely, that judge was a judge pro temp, wasn't even a judge in the first place, all right? Attorneys claim this could never happen. I talked to an individual who was there in the court and testified before a subcommittee of Congress in a special secret meeting concerning this case. It was a matter of national security was the concern. I have heard a number of similar cases or settlements. I do not believe people will be released from bank loans in the future without waking up a nation and outraging at least 10% of the voters, which is allegedly what started the Civil War. There was only 10% of the populace that was involved in the Civil War, which was really a war of northern aggression and absolutely had nothing to do with civil rights or being civil at all. It's an oxymoron. The very notion that there's anything civil about war is absolutely fucking blasphemy. They can control the media and judges, but not the facts, copy machine, and distribution of this book. When I first heard about local banks being involved in a fraud, I was going to prove there was no fraud. I knew what the CPA audit requirements were and knew there could be no fraud to prove my theory correct. I began asking my CPA students and others who attended the class if any of them were bank auditors. One of my student spoke up and claimed he was an auditor that went from bank to bank examining the records to be sure they were in compliance. At lunchtime, he gave me the bookkeeping entries. He said, "We credit liability column, cash, and replace it with the promissory note recorded as an asset." He claimed this means the bank loaned other depositors money. Then he showed the seller of the house receiving the money by debiting the cash, recorded as an asset, and recording as a liability, a new demand deposit account, checking account. Then he said, "Do you see the fraud?" I said, "No, because you gave the borrower cash." He said, "Look again. There is a new liability. Cash cancels out." "Oh, yes," he explained. "We redefined words. We call checks cash, and we really gave them a check, which is the opposite of cash." As he said the word fraud, the other CPAs standing around gasped, pretending they did not hear this conversation. The auditor explained, "We give the appearance of loaning other depositors money, but we change the intent of the agreement and change the promissory note so it funds the check." Then he claimed the average American would never figure this out. He looked at me squarely in the eyes and told me never to reveal this to anyone. He explained how it is like stealing and using the value of the stolen property to create new money and turning it back to the victim as a loan. He proceeded to explain that it is so profitable to those involved, they wanted to keep it a secret for themselves. As long as the people never figured it out, the lawmakers, police, judges, and professionals could keep transferring the wealth from the people to those who know the secret. The judges and police need the secret to continue, or they cannot enforce it. It is too profitable to expose. Then he tried to get my commitment to never reveal the secret. I never agreed. As an American, I believe everyone should know the whole truth and nothing but the truth concerning the banking system and bank loan agreement, giving full disclosure and equal protection of the law while abiding by due process of law. After reading my book, you know legal tender is recorded as a bank asset and a bank liability is owing legal tender. Then the bank calls the opposite of money a bank liability owing legal tender. Money, they call checks cash. Cash is the money and check merely transfers the money. Money bank asset must first be deposited to write the check. In other words, a promissory note must first be submitted, or the application, which is a promissory note. You'll notice they use all kinds of different words on these applications, okay, which is really an over-the-counter security, which is a primary obligation and duty by an active degree of fault, supported by Title 18, subsection 8, is an obligation of the United States, okay? The bank adds money and credit together to determine the total money supply. Credit is not money. It is the postponement of the payment of money, yet they charge you as if they loaned you, other depositors, money. This is essentially false and misleading and deceptive trade practices, honest services fraud. It's a breach of ethics. There's a whole litany of violations. And this, again, when you start to read Title 15, you will understand why Congress stepped in and said, look, there's an abundance of fraudulent activity in the realm of commerce, and we need to nip this in the butt. The bank acts like they fund the bank loan check when in fact the borrower funds it. A good expert witness will capitalize on the opposing side's weaknesses and minimize your weaknesses. A good expert witness will study their opponent's publications, picking out contradictions, false statements, and admissions. You are correct. I have done this for you. An expert witness studies court cases, learns why we lost, and develops a winning strategy. A qualified expert witness will have a set of questions the opposing expert witness cannot answer without exposing the truth and proving you are correct. To win, the bank must claim you signed the promissory note and were loaned a check. Volume 1 explains this and what you need to do to overcome the argument. The bank must try to claim they have the right to exchange, deposit, or create money, bank liability. To win, you must only argue the intent of the agreement and never allow the bank to prove money is a bank liability deposit. You must argue the bank has no right to trick you, steal, breach the agreement, and commit fraud, all while profiting handsomely for it, which is unjust enrichment. It's also holding the security while holding the proceeds simultaneously is a misappropriation of funds, which constitutes a felony. A bank liability deposit is not money, and this is the proof. A check merely transfers money. If you have a checking account balance of $100, the bank owes you $100 of legal tender. If the $100 was money, the bank would never have to give you back the $100 of cash or allow you to write a $100 check. If you write a $100 check to receive your cash, the bank check transfers the cash from the bank vault to your pocket, proving the liability. Bank deposit checking account balance of $100 is not money, but is owing money per the bank's operation. As an expert witness, you must understand that the national bankruptcy makes the judges, police, and lawmakers agents of the banks, or the bankers. The judge and the police have a secret agenda and job to enforce the banking system upon the uninformed voters. If you win because they do not want want this exposed. Your job is to expose the truth to the masses. The new bank loan agreements avoid claiming they loaned you money. They reworded the agreement to claim you must repay the bank principal and interest for the valuable consideration, money, the bank gave the customer, borrower. They still delete the part about the bank receiving actual cash value from the alleged borrower or customer and exchanging it for actual cash value. The banker returned. As an expert witness, it is your job to review the agreement and look for the words such as lender, borrower, loan, money, credit, and interest. The very definition of the words interest proves the alleged borrower intended to receive a loan and not an exchange. People keep making a fatal mistake. I keep hearing people say, if I win in court, I will fax it to everyone and that will sell books. Never forget the lawmakers, judges, police, and media will never allow this to happen. It is their job to keep the truth quiet. To win, you must get 10% of the American voters outraged, so the courts and lawmakers have no choice but to allow you to win or be voted out in the next election. Judges secretly helping us behind the scenes keep telling us they cannot rule in our favor unless the population first supports it. A good expert witness will organize a group showing the vision of winning America back by copying and distributing the brochure and tapes and recruiting others to do the same. Sheer numbers of voters joining will force us to win. No judge will want to rule against you if he or she believes next year the majority of the voters will be outraged and wanting to place criminal charges against those aiding and abetting the bankers. History shows people have turned against their rulers and corrected their problems. As Americans, we reject violence and illegal means to accomplish this. We use our freedom of speech and the vote to correct the problem. A good expert witness helps the judge make the right decision by allowing the other side to default or traverse into your trap. Allow the judge to save face so he or she can help you win. Example, you claim the note is forged and sold and recorded as a loan from you to the bank, changing the cost and the risk. The bank refuses to give you a copy of the original note, proving you wrong. The judge could save face and claim the bank must show the original. The bank will claim it was destroyed or lost and give a copy. Without the stamp on the back, now you demand to know if it is bank policy to stamp the back of the note and use the note to fund the check. Now you are back to intent of the agreement. The bank wrote the agreement, advertised, and wrote the bookkeeping entries, but failed to sign it because they knew the truth. If they did not sign it, they have a problem. The bank claims you signed it, which allows you to tell what your intent was. The intent was for the promissory note only to be used as a guarantee repaying a loan. A check the bank were to loan as consideration, money loaned for the bank to allegedly obtain the note, not for the note to be given freely to the bank with no consideration loan, and the note funds the check and the value of the note returned back to the alleged borrower as a bank loan. An expert witness is used to persuade a jury to vote in your favor. Keep it simple and use everyday language they can understand. The bankers must keep it complicated to confuse a jury. It is your job to keep it simple. The bankers will never know who read my books and listened to my cassette tapes. They will never know if you are pretending to not really understand the material, leading them into a trap. Or if you truly understand it, this unknown will keep them in line and in fear of arguing the agreement. Do not forget the special CPA report you need. So immediately after doing business with anybody, you want the special CPA report. You're going to demand it. You're going to require in 21 days they produce it. Or you're going to use Regulation Z and cancel the security agreement, okay? And you're going to cancel the collateral that's attached to the security agreement. Now they're up a creek without a fucking paddle, all right? This is kept confidential and is a trade secret of mine. Summary: a good expert witness will know how to legally attack the opponent's expert when the bank tries to defend the court action. Volume 1 and 2 have taught you how to argue the agreement and take on the banker's expert. Chapter number 7. Why we ask the questions. Well, I'll tell you right now why we ask questions. Because he who makes a statement bears the onus of probandi. You must prove. But he who's making the claim, we put the onus of probandi back on them by simply asking questions. And we structure our questions in a way that always leads to a positive result for us, okay? The true creditor, the true lender, and dare I say the borrower. Because we're the alpha and the omega. We're the whole ball of fucking wax. And at the end of the day, ladies and gentlemen, if you are receiving what I'm putting out there, you too can understand that you have all the power in the world. You want in, you don't want out. You want in. And this is how you get in, by acquiring the knowledge. You've never been barred from your estate. You've never been barred from creating new monies on account or creating bills of exchange or anything like that. It's quite the contrary. You've always had that power. You've had that power since Proclamation 2039, since the Federal Reserve Act in 1913, since the abrogation of the Gold Clause in 1933, and finally in 1971 when they completely did away with the gold standard and moved to the petrodollar. You have always had this power. In 1881, you had the power to create bills of exchange and international bills of exchange. You just didn't have the knowledge to be able to use it, all right? And that's what this is all about. We ask the questions. The questions are the key. First, know what the Federal Reserve Bank publications state. If the banker lies, you can point to the publication. Once he admits, he must follow the Federal Reserve Bank policies and procedures. He must admit he refused to follow the Fed policies and procedures, or that the bank exchanged value for value and called it a loan. Now, once they do that, that's grounds for contacting the FTC, the SEC, the Fair Credit Reporting Bureau, and a number of other entities to ensure that an investigation starts right away post haste. They're not going to want to deal with you after you do that. We ask the questions to show how the banker redefined ordinary words to mean the opposite. They call checks cash and the opposite of money, money, and exchange is called a loan. A loan from you to the bank is repaid back to you, calling the repayment a loan from the bank back to you. Our main questions are not concerned with what happened 10 years ago at the bank that no longer is in business. The banker's strategy is to buy and sell banks, covering up the original transaction. To counter this, we ask the question according to your understanding of the alleged agreement. The banker will then claim they loaned other depositors money, which is illegal and actually a crime. They can't do that. They're barred from doing so. Okay, and they can't extend their own credit either. So where did the credit come from? That's where the MoneyNet Daily Log Transaction Report 120 comes in from the Securities Exchange Commission, that shows where the source of the funds came from and the destination of the source of those funds, okay, or the destination of those funds, which shows that they came from you and they came back to you. Ask them to show proof that the banker loaned other depositors money and the other depositors cannot spend the money and you can. We ask questions regarding bookkeeping entries. If the bank assets and liabilities increased, it proves the promissory note funded the check. If the promissory note funded the check, then the check never could be considered loaned. Consideration loaned to be the promissory note. They cannot answer whether the chicken or the egg came first. On a blank sheet of paper on the same line, place these three words: note, check, note. If the note funded the check, the bank claimed they loaned no actual cash value for the note. If the check was loaned as consideration for the note, the bank must prove they violated the Federal Reserve Bank policies and procedures, or the check is check kiting. no money first deposited for the check. The bank cannot expose the truth because of the written agreement and advertising, which is false and misleading and deceptive trade practices, false and misleading statements under Title 15, 1692E, Title 15, 78FF. It's interference with trade and commerce, which is a violation of Title 15, subsection 1, subpart 1, which comes at a $100 million fine. If you don't think the United States Treasury was interested in that, you're kidding yourself, all right? Never ask a question of law regarding whether the promissory note is money. The judge will claim that it is a matter of law and only he can rule. He will never rule. Always ask the banker, is it your policy that the promissory note is or is not money? If it is, give them more money. If it is money, you provided the bank with money to fund the check, so where is the money the bank loaned? If it is not money and the bank liability is owing money, a check is not money, and the Fed claims the bank did not loan other depositors money, where is the money? Okay, this is where we're talking about they're holding the original security and the proceeds at this point, and it's a misappropriation of funds, it's unjust enrichment, it's tax evasion, a number of other crimes. The bank cannot own or sell the note until they legally gave consideration in accordance to the agreement. So we have a breach of contract. Credit is not money, and a check is payable in money. So how can a check be paid in credit? The postponement of the payment of money. The questions are asked to exploit the banker's weakness. If they cannot explain what the real agreement is, how can there be an agreement? The questions have many topics. They discuss the agreement, bank policy, intent, money, credit, who funded the check, bookkeeping entries, bank auditors, court cases, bankruptcies, etc. One main reason we ask the same type of questions 5 ways is so the bankers will know every American is fully equipped to ask the pertinent questions. Just having the questions in both volumes means they dare not get into the argument with you. Never forget the bank must claim they do not know. Expect them to use direct lies, the lies of omission and the lies of equivocal behavior. You ask the question, they know the answer, and they shrug their shoulders, making you think they do not know. You must make the question so simple any child can understand. Many of the questions in this book are compound questions. If this were a real court, one would break the compound questions down into several questions, okay? Because compound questions lead to people being able to go, I really don't understand what you're saying. So one question, one noun, one subject matter for one answer. And if you can structure those questions into yes or no questions, you're far better off than having them ramble on some bullshit excuse and explanation as to how they're trying to justify their way of doing business, right? We always want those questions to be yes or no questions, and that way we can nail their nuts to the wall. I use compound questions to cut pages in the book and help with understanding. The questions are designed to show you how to ask questions. Once you have the idea, you can rephrase it many ways. Do not ask the questions you do not know the answer to. This book discusses a universal banking problem. If you are in a real court, never make it appear to be a universal problem. You must make it appear to be only your problem. Your documents were forged, changing your cost and risk. So there never was a loan. The mortgage is not in arrears. The bank refuses to produce the IRS form 1096 or 1098. So never was a loan. It's not in arrear. The mortgage is not in arrearages. And everything is a forgery. There you go. There's your 4 statements right there, and the bank can never prove otherwise. You loaned the bank, they paid you back, and they made a mistake by calling the repayment back to you a loan. In the end, all questions are centered around how the bank made false statements, used deceptive and misleading trade practices in the form of deception, and changed the cost and the risk, unjustly enriching themselves all at the same time while casting you into peonage. bondage, slavery. Make it sound like no one in their right mind would ever agree to deposit money and have it withdrawn as a loan back to them. You cannot win because of the law. You may win because of the agreement, contract, and because you embarrassed them. They can always change the laws to suit themselves. They cannot change morals, and making the real agreement look so ridiculous no one would enter into it unless they were insane only works in your favor. Because if you were insane, you were incompetent, and you couldn't have entered into that agreement anyway, which would make it a nullity in and of itself. The ultimate aim of asking questions is to expose the fact that they change the cost and risk. The bankers end up with everything and risk and loaned nothing, having any actual cash value to obtain the promissory note. They simply transfer your wealth to their pocket for free. Use this new wealth to create new money and use the new money to return the wealth back to you as a bank loan. Chapter 8, Accounting Principles. The bank auditor must comply with all accounting principles. Each one of the following 4 accounting principles proves our case. Before we discuss the principles, however, we should define assets and liabilities. An asset is something one can sell. It has value. Asset consists of items like cash, promissory notes, letters of credit, bills of exchange, IBOEs, international bills of exchange, cars, and houses. A liability is owing money. A debt is a liability. The principle of matching requires that the revenues sale match the expenses associated with the revenues. It also requires assets to match liabilities. Example, if you loan a company $10,000 cash, the cash is recorded as an asset matched with a liability of $10,000, showing the company owes you $10,000. The liability is proof you loan the cash to the company and they owe you the money. It is illegal for the company to receive a $10,000 loan from you and then claim they do not owe you the money, that they owe another person the $10,000 and pay the other person the $10,000 they owe you. The principle of matching demands that if the bank records the promissory note as an asset matched by a new liability, the new liability, deposit, or check is money they owe you. So when you give them the promissory note, they owe you the funds. All right? It is illegal to convert the liability to another person and not pay you. More precisely, the bank took your promissory note, recorded it as an unauthorized loan from you to them, or deposited it, resulting in a new liability. They never told you about the transaction. The principle of matching demand that the bank return the value of the promissory note back to you, plus all interest. The bank auditor and banker cooperated together in keeping this knowledge from you. The bank's legal form bank loan agreement claims there was a loan, when in fact, economically speaking, the bank owed you money from the unauthorized loan to them. They kept the money owed to you by refusing to match the promissory note to the new liability that should have been recorded as debt to you. 2. Accounting principles, representational faithfulness means GAAP, generally accepted accounting principles, requires that the economic substance proves what event occurred regardless of what the legal form said. See the book 1997 Miller GAAP Guide by Larry P. Bailey, page 3.05. This book is used for CPA continuing education requirements of licensing renewal. The accountant recorded the economic event as a loan from the alleged borrower to the bank, and the value returned as a loan back to the same alleged borrower. This was an exchange or deposit, and a fee was charged as if there was a loan. The legal form only discussed the loan from the bank to the alleged borrower. GAAP, generally accepted accounting principles, requires the written agreement show the authorization permission, and knowledge to record the bookkeeping entries of a loan from the borrower to the bank. There was no knowledge, so there is no authorization or permission or permissible purpose. Without written permission, consent by you, or knowledge, the auditor and banker failed in the accounting principles of representational faithfulness. Clearly, from these two principles, the bookkeeping entries are similar to fraudulent conversion of an asset, promissory note, to the hands of another, while unjustly enriching themselves and compelling a performance out of you while failing to accurately report and pay the taxes, which constitutes tax evasion, which I'm sure the IRS would be more than elated to hear from you about. Using the value of the asset to loan back to the victim it was taken from. These two principles clearly prohibit such a transaction. 3. The principle of the conservatism simply states, when in doubt, do not overstate assets and income. See the book Intermediate Accounting by Kiso and Wiggett, page 37. This book is used in major universities to teach future CPAs. This simply means that the loan from you to the bank must be returned back to you as a return of the loan from you to the bank, and not as a loan from the bank back to you. 4. The objectivity, verifiability principle means that the CPAs who understand the accounting information must depend on a objectively and verifiable information. The book Intermediate Accounting explains that if two CPAs examine the same bookkeeping entries, they should agree about what the agreement was. Page 34, the translated version means if a CPA did not know anything about the bank loan agreement and only saw the bookkeeping entries and asked what is the agreement per the bookkeeping entries, they would conclude there was a loan to the bank returned as a loan from the bank to the alleged borrower, that the bank deposited the promissory note or sold it and deposited the proceeds of the sale, or a fraudulent conversion or theft, or the borrower gifted the promissory note to the bank, and that the bank never loaned 1 cent of actual cash value to the alleged borrower to obtain the promissory note. The bank auditor must come to the same conclusion if he had the competence to audit the bank in the first place. The money trail and accounting principles prove our point that the bank loaned nothing having any actual cash value or a check to obtain the promissory note. The agreement did not disclose that the bank simply obtained something of value from us for free and returned the value back as if they had loaned us their money. When we return, we'll be talking about Chapter 9, Certified Public Accountants, Audit Requirements.